Hey gang, Matt from Easy Breakouts, about to start another current market trend review, but before I do, just wanted to mention that if you find this video helpful, be sure to click on that subscribe button down below. Also, you can view additional videos by visiting our YouTube channel. Alright, let's hop into our analysis. So folks, as you can tell from our scorecards here, we had all four of the major indices down, all four of the major equity indices, Dow, S&P, Russell, and the NASDAQ. And in fact, the Russell was the leader to the downside percentage-wise, off about 0.94, almost 1% down to the downside. We had the crude kind of just balancing out today. Bonds came off and the gold came off as well, so we'll see all of this on the charts. But as always, we'll take a look at the analysis here, starting off with the S&P 500s on the daily charts. And folks, not a whole lot has changed. In fact, we've really gone into a very tight trading range over the last, 3 or 4 trading sessions. We're still looking for potential breakouts up and over the 2280s. But folks, if you look at this today, we stacked up another heavy volume selling day. You'll hear us sometimes refer to that as a distribution day. It's how we track institutional selling. So we've been seeing here that we've been piling them up ever so slightly as we've been going sideways in this bit of a range. And folks, I'm looking for a breakout up and over or down below to get any sort of indication on direction here. So if we zoom into the intradays, you can see a lot more clearly why those 2280s are important. We did have a little intraday sell-off here today, a little bit of intraday volatility. It felt a little bit more like maybe the bots or the algos just fishing for some sell stops. We did manage to close off of the lower levels, but just be aware that probably the place to watch here on the S&P, the earliest tell that there might be a bit of an off or a bit more of a bigger pullback in the making is if you break down below these 2250s. And then obviously if you break down below the 2230s, that's going to be a bit problematic for the rally that we're in right now. It could also potentially be inauguration jitters. We'll have to see how this market responds after President-elect Trump gets sworn in here. But that could be part of the issue as well. It could also be that we've got big cap earnings up on deck. Amazon, Facebook, Google, Microsoft, Apple, they're all going to be reporting in the next week and a half as well. So there's a lot of factors still weighing on the market, and that's potentially why we've seen just range-bound trade over the last 5 weeks now. Going on 5 weeks, we've been going sideways. Now, speaking of big cap techs, let's move over to the NASDAQ here. Taking a look at the NASDAQ, one of the things I was pointing out to our trading room earlier today is how we've been making these series of higher highs, which is good, right? That's the sign of a healthy uptrend, higher highs, higher lows. So that's a good thing. And we've also been mentioning how the relative strength is coming back, creeping back higher. So all of these things point to maybe a bit of a shift back into tech stocks. We've been watching a lot of these names like the Amazons, Facebooks. They're starting to form cups and bases that potentially might break out coming down the line when earnings are released. We also had the Netflix reporting earnings on Wednesday afternoon, and Thursday trade we got to see what happened. It gapped up. It started the day up early, up about $144 a share, closed down at 138. So folks, that's kind of a bit of a reversal there on that stock. A bit of sellers might have been attracted by that $140 level. But here's the thing to keep in mind, not just for this one stock, but as you're watching earnings plays, you're going to see a lot of gap ups along the way. The key here is to not lose track of the stock. And what you can do a lot of times is if you zoom into the chart, what will happen a lot of times is the stock will kind of vacillate around here, and it'll form like a series of like intraday highs. And folks, that's what we call a high handle. And a lot of times these stocks that gap up, they need some time to digest the move. They'll work sideways, and then 3-4 days later they might start breaking out back above those levels, and that would be the place to look for these stocks as an additional entry. So again, as we're going into earnings, I know it's frustrating sometimes that where you can't trade a stock, it looks perfect, it's got a good cup and handle, it's got a great double bottom, and then earnings comes out and you really just unfortunately can't take that overnight risk, right? The headline earnings risk. You could be up 20% one night or down 20% in that same move. So folks, a lot of times if you have the rip higher, it may feel like initially you lost the stock, that it ran without you. But more often than not, if you just stay on the stock, keep watching it,
they will give you additional entries. Okay, so that's kind of the game plan going forward in this earnings season. Folks, taking a quick look at the gold here. Gold backing off to the 1200s. I'm just going to zoom out here. That's kind of what this is starting to look now more what I was expecting, which is a bit of a balance, a bit of a battle right around these 1200s. You overshoot, you undershoot, you go sideways, and then after about a week or so, maybe 2 weeks of this sideways action, maybe we can get some resolution on a break higher to test the 1250s up top, or if we're going to kind of start rejecting lower and breaking down below the 1200s. But right now, back and forth sideways action right about 1200. That is kind of what I was expecting to see at this area on this first attempted test back up to the 1200s. Taking a look at the bonds here, folks, we've seen an offer starting to build back into the bonds. After a nice bounce here in the middle of December, we've been rallying all the way up to these 125 evens, and then we hit the 125 evens 1, 2, 3, 4, 5 times, not able to get above it. And one of the things we learned about that's called resistance. It indicates sellers in that area. And overall, I think there's a lot of headwinds going against the bonds. If you back out of this chart here, going all the way 10 years back, you'll actually see here that these support levels that we're kind of bouncing off right now go all the way back to 2013s and 14s. If you break down below the 123 evens on the 10-year futures, folks, it looks like maybe down to the 117s would be a likely place, a test for those 10-year bond futures. And then finally, taking a look at the crude here, folks, the crude's been in that no man's land I've been talking about for the last week or so. Not able to break above 54s, not able to break down below 51s. We continue to just trade sideways, folks. Just look for a breakout up and above those 54s or down and below the 51s for any sort of directional bias or momentum building in that. But other than that, folks, just a pretty quiet day. We're going to wait to see how the market reacts to an inauguration. We've got some Fed speakers on deck for Friday morning. But other than that, folks, have a great trading day ahead and join us for our next market trend review.
Hey, by the way, if you haven't done so already and you're liking the analysis, go ahead and hit that subscribe button down below. And as a reminder, you can also view additional videos by visiting our YouTube channel. Or if you'd like to find out more about Easy Breakouts, go ahead and click that Show More right above the comments section to find out more about Easy Breakouts. But other than that, have a great trading day ahead, and may the trend be with you. Take care, everyone.